Welcome to Chapter 11 of the Wealth Management Essentials course. In this chapter, we're going to be talking about employer-sponsored pension plans. There are 4 different learning objectives in this chapter. We will be talking about some different employer-sponsored pension plans and some registered plans for funding retirement. So there are a few different types of employer-sponsored plans. The first one being a group RSP. So it is similar to a regular RSP, except that it is set up through the employer, and usually the employer will match a certain percentage of the employee's salary. So for example, an employee might contribute 2% of their salary per pay, and the employer matches this for another 2%. The other type is a registered pension plan, or RPP. This could be a defined benefit pension plan or a defined contribution pension plan. So the defined contribution pension plan, it is similar to a group RSP, except they can be contributory or non-contributory. Non-contributory is where the employer is the only one who contributes. Now, when the employee retires, this account must follow the Pension Benefits Act, and that is the main difference between the RPP and the Group RSP. So by following the Pension Benefits Act, it's normally transferred to a LIRA rather than an RSP. So LIRA is a locked-in retirement account, and this means that there will eventually be a maximum amount that you can take out of the plan each year, whereas with the RSP, you can take out as much as you want. So it does have to follow those pension rules, and the pension rules just have some limits on them. Basically, it's designed to last until you're 90 years old. There's also the defined benefit pension plan. So this provides the employee a monthly payment each month when they retire. It's similar to an annuity, so it is pretty straightforward. It tells you what you'll get every month. Some of them will give you more before age 65, and then they'll drop that amount just because you will be getting old age security. You could get CPP at age 65 if you choose not to take it early. So that's how those work. Next, we're going to look at some key aspects of the Pension Benefits Act. So for members to be eligible for full-time employees, they need to be with the company for 24 months of continuous employment. For part-time employees, it's the same thing, but earnings also need to equal 35% of the year's maximum pensionable earnings in each of the 2 consecutive calendar years. Maximum pensionable earnings, it is just a standard amount. It does go up each year. Vesting of benefits. So some of them are full and immediate vesting for all accrued benefits. There is the option of locking in. So this is 2 years of continuous plan membership for the benefits accrued from January 10th, 1967. There's also the minimum pension benefit credit. So the pension benefit credit of a defined benefit pension plan member cannot be less than the aggregate of the member's required contributions, together with interest in the following situations. So when a member retires, when a member ceases to be a member, when a member dies, or when the whole or part of the plan is terminated. Now, when looking at marriage or common law relationships, so pensions, they cannot terminate when a member marries or enters into a common law relationship. The spouse of the member also has some rights around the pension and is entitled to receive a survivor amount in most cases. Pensionable age, so this just refers to the earliest age when the member is eligible for an unreduced pension. Now, just taking a closer look at the defined benefit pension plan. So there are a few different ways it can be structured. One is a flat benefit plan. So this is the simplest type. The monthly pension is a fixed dollar amount for each year of service. So for example, they might get $150 per month per year of service. So if they had 30 years, they get $4,500 per month. So it's easy to understand, but also does not differentiate between the earnings levels of employees. There's also the career average plans. And so employees usually contribute a percentage of their salary. Monthly pensions can be calculated as 2% of the salary times the average monthly income of $6,000, for example, times the 30 years. So in this case, they'd get $3,600. So this structure, it does allow many employees to improve their earnings throughout their career, which does benefit them. And the pension can sometimes be eroded by inflation, so that is a downside. There's also the final and best average plan. This one is probably seen a little bit more often. So plans typically use the employee's best 3 or 5 year averages. It does provide better protection against inflation. And final average plans, they can be bad for employees who have lower salaries in the last few years. But with the best average plan, that's the better structure. That way, if an employee, say, takes a pay cut in the last few years, it doesn't really matter. There can be some obscure scenarios where you think of an employee, they don't really earn much throughout basically their entire career, but then in the last 3 years, they get a huge promotion and they're maybe a vice president or manager or something like that. And so in that case, they would end up getting a really good pension because they do have a lot of years of service, although they didn't make very much earnings for most of it. But it goes off of their best average salary. And so they would take a look at their salary when they were either manager or vice president or whatever. There's also pension adjustments. So this happens whenever someone's a part of a registered pension plan. So the pension adjustment, there is a maximum pension benefit. It's 2% of $171,000, which does change, but $3,240 as of right now. It is calculated as the pension benefit entitlement times 9 minus 600. And the pension adjustment, it is the amount of contributions made by or the value of benefits accrued to a plan member for a calendar year. The pension adjustment allows plan members to determine the amount they can contribute to an RSP without exceeding their annual contribution limit for all registered plans. So now we'll take a look at the defined contribution pension plan. It isn't as heavily regulated as the defined benefit plan. And final pension amounts, it is unknown until retirement. So that is a bit of a downside. It's also dependent on investment returns. Employees can sometimes choose their investments. However, some plans invest the money the same for everyone using a pension company. Contributions cannot exceed 18% of the employee's salary. Some pension plans offer employees the choice between the defined benefit and defined contribution plan, so that way when they go to retire, they can sort of weigh the pros and cons. Usually you would look at a break even, so if you took the defined contribution pension, you get this lump sum of money, and how long could you take the defined benefit amount out of that lump sum, and you can find the break even age. Estate benefits, they're usually better with the defined contribution pension because the entire amount can be transferred to a spouse or estate upon death, rather than just having the survivor benefit, which is with the defined benefit pension. Defined contribution is also much more flexible. With defined benefit, you're getting this set amount every month, but defined contribution, you can take different amounts for different months or different years, so there's a lot more flexibility there. Next, we're going to talk about pooled registered pension plans. This is useful for people who are not offered pension plans through work. They can sometimes take part in the pooled registered pension plan, which allows them to pool their funds together with others in similar situations to have it invested and growing with less admin costs and other management costs. Employers are not compelled to contribute to the pooled registered pension plan, so that is a downside. It's sort of, you're sort of contributing with your own money. The only advantage is that the costs can sometimes be less than just investing regularly yourself. Otherwise, it is worse than an RSP since the pooled registered pension plan, it is governed by the Pension Benefits Act and then must follow the restrictions and the maximums and everything. There's also individual pension plans. So this is a defined benefit pension plan that's usually established by a company for one employee who is often the owner or manager. It is costly to set up, but may provide greater benefits and a higher contribution limit than just a regular RSP. The company must be incorporated. You also have the Connected Persons Plan. So this plan is designed for owners or managers who own more than 10% of any class of shares of the company or who do not deal at arm's length with the plan sponsor. So this type is most likely to be used by incorporated self-employed business owners. And then there's the Non-Connected Persons Plan, designed for people who are not shareholders or who own less than 10% of the company's shares. And they're often used to attract or retain senior management. They're most likely to be used by employers that want to provide and enhance the retirement benefits to a key employee. The Retirement Compensation Agreement, or RCA, so this allows employers to pre-fund retirement benefits without using an RPP. It's not registered with the CRA and there aren't any contribution limits. Usually it is used with owners of privately held corporations or executives making over $171,000 as of 2022. That number does go up each year. The RCA, it is a taxable trust set up by an employer with the employee as the beneficiary. Investments in the RCA, they're governed by the trust agreement. So money invested is divided equally into two accounts. You have the RCA investment account and the refundable tax account held by the CRA. So half the earnings from the RCA account are forwarded to the refundable tax account held by the CRA each year. For many years, the 50% tax rate deterred people from using this account, but with the highest tax bracket being slightly over 50%, it does have some situations where it can be useful. Now, the best use of RSPs during retirement. So clients that retire before the age of 65 should consider taking money out of their RSP before they turn 65, which is when they usually begin receiving OAS and CPP. Transferring the RSP to a RIF by age 65 has some additional benefits as well. It allows the income withdrawn to be considered pension income, which can then be split with a spouse. It's also eligible for the pension income tax credit, so you can take that money out and you can get a tax credit and just generally save some taxes. It is only applied to $2,000 per person per year. RIFs also, they have less withholding tax since the minimum does not require any tax withheld, so that can be a benefit sometimes. And of course, the RSP must be converted to a RIF the year the person turns age 71, and the minimum would have to be taken out the following year when they turn 72. Sometimes it does make sense to withdraw from a RIF a bit faster than needed to ensure that there isn't a large lump sum left in the RIF when the account holder and their spouse pass away. Once they pass away, it would all be taxed at once on their final tax return. So sometimes some clients might be worried about that, and they want to have some strategies in place to draw it down over time. The proceeds of an RSP, it can be used to purchase a life annuity as well, which can sometimes be used, especially if a client is quite old and their RSP is made to delete in a few years. Maybe they just put that money towards a life annuity. Clients, they can also take advantage of overcontribution at age 71, so just a small tip there. Now the LRSP or the LIRA, so just some more information about that. They are accounts that are similar to the RSP, but they must follow the Pension Benefits Act. Employees who have an RPP can transfer it to an LRSP or a LIRA depending on the province and jurisdiction of that pension. So they can be converted to a LIF if the client is at least 55 years old, and by converting the LRSP or LIRA to a LIF, it creates a minimum withdrawal each year and a maximum that can be withdrawn as well. If you just have a LRSP and a LIRA, you actually can't take money out of it until it is converted to a LIF. So that's why you would want to do that. It must be converted the year they turn age 71, just like an RSP. Essentially, the LIF is the same as a RIF, but it just has a more restrictions since there is that maximum annual withdrawal. And finally, we're going to talk about annuities and retirement. So there are a few different annuities that could come up. You have the Advanced Life Deferred Annuity. So this allows a client to move some savings out of their RSP, RIF, Deferred Profit Sharing Plan, or a LIF, or the Defined Contribution Pension Plan, to an annuity deferred until age 85. There is a purchase cap that was set at 25% of the source plan to $160,000 lifetime dollar limit. It can be used to manage longevity risk and clawbacks for old age security and the guaranteed income supplement, since you are putting this money in and deferring it until 85. So that would be some of the more useful cases for it. You also have the variable payment life annuity. So this provides payments that vary based on the investment performance of the underlying annuity. And it is permitted under the pooled registered pension plan and the defined contribution pension plan. And so those are all of the main topics in Chapter 11. I really hope you found the review helpful, and I will see you all in Chapter 12.